Good morning, everyone. Happy Thursday, and welcome to our second virtual Metals Investor Forum. I'm very happy to be here and kicking off the first session, and very glad to host all of you. Thank you for your time and attention and your interest in, the metal space and then the companies who are presenting in my session right here and all through the day. I will jump into my presentation here, but I do want to remind you all that we love questions, and we will, as usual, be hosting a Q&A at the end of the session. In our physical MIF, you have to wait until the Q&A to ask questions, but on this virtual platform, there's a little icon at the bottom that has a hand. So anytime anybody's speaking and a question crops up that you would like to ask, click on that icon and you can enter your question, and then they queue up. I can see them, and then I can pose them to the appropriate person or answer them myself if they're for me during the Q&A at the end. So with that, let me start sharing my screen here and jump into what I have to say. So if anybody was at MIF last time, it's the same headline, because I do think, that was only 2 weeks ago. The general situation has not changed to me. It has only solidified as we've gone through these last few weeks, which have been a little bit quiet in the market. And I describe it as oddly quiet because we are still in the midst of an unprecedentedly weird time in the world, and financially and economically, and yet the markets have been a bit quiet. So I've incorporated some of that into my thoughts here, but really this is a health crisis, an economic catastrophe, and a golden opportunity. And so what I want to start with here is why I am so fundamentally bullish on gold. And I'm going to go through a few slides here that just one after another take us through the list of points that all are pushing behind gold. And I can start by saying there are two forces, I would say, that are working against gold now. The strength of the US dollar is obviously a bit of a headwind that plays out in a few ways. One, gold can certainly gain in a strong US dollar environment. We've seen that happen under the right economic conditions many times in the past. So that's certainly not a showstopper. And the other is a lack of jewelry demand. So those who really focus on supply demand in the gold world are concerned about the lack of jewelry demand in the gold space. It's not a main focus for me. I think investment demand is so much more important in this context that it doesn't bother me much. Obviously, it would be great if jewelry demand were also strong. It's not. But I do not think it is a particularly significant factor. And all of the other forces that we need that usually propel gold are perfectly aligned. So leading that pack certainly is negative real rates. And they are the most important pro-gold force always. And we clearly have negative rates right now. If you look at the US 10-year, it yields about 0.6 these days. Take inflation away from that, no matter what you take away for inflation within some reasonable range, it's still costing you to own that note over its duration. So that's the kind of setup that encourages people to look for a different safe haven. Gold has always stepped into that gap, especially because it performs in the kinds of environments that create negative real rates. And that's precisely where we are right now. What's interesting is just this week, the futures market, the stock market, if you look at the S&P, doesn't feel like we're in the midst of an economic catastrophe, right? Like the bounce has been unreal, like it was on a bungee cord. But the futures market, which I would say is a little bit more analytical in its investor base, is just actually increasingly pessimistic. As we've gone through March, April, and May, you can see that the expectation for the federal funds rate, this chart on the left here is the expectation for the federal funds rate in June of 2021, so just over a year from now. It keeps getting worse. So the futures market thinks that the futures market is very not optimistic. This is something I talked about in my letter yesterday. We're kind of in this optimists versus pessimists dance right now because we're in this unknown waters, and so there's no playbook to go by. So it's sort of like whether the optimists or pessimists are winning the day determines where gold and the stock markets go on any particular day. but there are certainly lots of reasons to believe that the pessimists will carry the day at some point. Okay, so gold forces all being aligned. Uncertainty is a bit of a nebulous term, but there's lots of specifics within that right now that you can point to. Obviously, we don't know what's going to happen to the markets. Growth is a big question. Are we going to get inflation or deflation in the near term versus the long term because of all of this unprecedented monetary action? There's all kinds of politics that are very uncertain. I mean, the US-China relations deterioration in the last month is really significant. Do you remember what an impact that had on the markets in 2018? It was big. It had gotten better, and now it's worse. Those relations are worse than they were in 2018. So that really matters. So amidst all of this uncertainty, gold is certainly being sought for security. And this bullet point that I have here, I think is pretty interesting. Gold inflows into gold ETFs have already this year, 4.5 months or 5 months into the year, have already broken the annual inflow record for gold ETFs, which was set back in 2009. There's been $14 trillion gone into gold ETFs in 4.5 months, which is 14% of the money that's gone into ETFs everywhere, even though gold ETFs only represent about 2% of ETF assets under management. All I'm saying is that the rising interest in gold is very real. And it's because gold is sought for security amidst all of this uncertainty. Then we have this unprecedented monetary situation. I have just a bunch of question marks there for overall impacts, because you could spend the next month reading one article about why it's going to cause inflation and one article about why it's going to cause deflation on repeat. I've spent a whole day doing it already, and I still don't know long term how this is all going to play out. There's very interesting, complex arguments on both sides. In the near to medium term, we do know that it is very good for gold. So certainly the monetary situation is supportive of the gold situation. Big picture wise, we had a major stock market crash, of course. We've already had a big bounce out of that. What's important, I think, when you're looking at that is to look back at the stock bull market that we've had for the last decade almost. And in that scenario, buy the dip is an action plan that has worked really well for investors. Every time the market has dipped, if you just bought the dip, guess what? It came back and you benefited from that action. That history, that pattern, means that there's a lot of dollars that quickly wanted to profit from the mayhem that we had in March. That, of course, is a big part of the reason why the markets bounced on a bungee cord like they did in April. But after that initial bounce, then the real questions come in. What are the fundamentals? What's going to happen in the big picture? And as money settles into where it wants to be for the longer term, not just for the bounce, it is really broadly recognized that gold bottoms first out of these sorts of catastrophes. It is less likely to slide again if there's a second bottom. And so, I mean, these two charts show the late 2018 correction, the global financial crisis, gold coming out of those strongly first. And that's an important part of what's going on. Oops, I don't know why that just happened. Sorry, I don't know if my slides are looking funny to you. There we go. Whoa. There we go. Sorry. My computer decided it had several desktops, which I've never actually seen before. So I think that's very important, because investors who are now through this crazy turbulent bounce aspect of the market are going to look for somewhere to sit. And gold is an obvious candidate in that question. And then I think it's also really important when you're looking at big picture money, generalist dollars are the thing that we have needed for the gold space to get going. And it is really important that those generalist dollars are here now. Part of the reason for that is that funds have not had to look for value for years. The stock market has just handed it to them on a platter. And the sort of nature of funds is that they're all benchmarked, and all they have to do is outperform the benchmark a tiny bit to be successful. And so what they primarily do is just buy the market and then try and do one or two trades on top to inch themselves above, and that's what they do. So they haven't looked for value, really. They've just bought the market. Now that is no longer a reliable plan because there's so many uncertainties about what the market is going to do. So in looking for value, a lot of generalist dollars, whether they believe in a gold bull market or not, if they just look across equities, gold miners stand out. We've gone through a whole bunch of cost cutting and fiscal prudence for years. Now we have an incredibly strong gold price, especially if you're not in US dollars, if you're operating in Canadian dollars, for instance. But you put those two together, and gold miners offer some of the best earnings and balance sheets around, like across equities. So that really matters. A generalist fund manager does not need to be a gold bull to see that there is value and upside in, there's value and security, and then upside if you believe in the gold market, in buying gold miners. So I really think that it's important to realize that is playing a role in attracting the generalist dollars. I mentioned this a few weeks ago, but I think it's a really good anecdote to underline this thesis that I keep blathering on about, which is that the generalist dollars are here. The head of Fidelity, the Contra fund is the largest mutual fund in the world. It is sort of hard to wrap your head around how big it is, $150 billion. And the head of Fidelity on an internal call to those fund managers was incredibly bullish on gold. Now, if you imagine that direction, that directive, meaning that some small percentage of that fund gets put towards gold, that makes a huge impact on the small gold sector. And that is what creates a gold bull market. There's a huge amount of money out there that does not usually play in our space. When it decides that our space is the place to be, that's all that money trying to fit through a tiny little gate is what causes gold bull markets to really go. And that is seriously starting to happen now. It will take a while to play out because it takes time for a lot of money to move anywhere. So it's not over, but it is certainly the force that has created share price charts like we're seeing here in the majors. And it's one of these lovely gold market momentum things, which is the more inflow and the market rises, that attracts more inflow. It's a self-fulfilling prophecy to a certain extent. So it's here, it's happening, and it's pretty exciting. I also wanted to add in a comment that we saw some, just this week, we saw 3 deals of scale, a merger of equals between SSR and Alasar. We saw Adriatic Metals taking over an Explorer for a portfolio of projects in Serbia. And then we saw Gran Colombia pushing this 3-way merger that's a friendly combo with Goldex and a hostile takeover of Guyana Goldfields. That kind of M&A activity adds to the gold market momentum. So, when you see a hostile so first of all, when you see deals happening, that means, first of all, that mining executives have confidence in the gold bull market. They have enough confidence that they're pulling the trigger. That creates excitement among investors. And importantly, it encourages the other miners to also make the kinds of M&A moves that they've been considering because they don't want the assets to get scooped out from under them. So deal making really helps add momentum to a gold market. And that third example, the Gran Colombia example, includes a hostile, and that's a bidding war, and that only amplifies the momentum that deals add to a gold market. So I think that's a nice addition that we've seen to the space in the last week. Okay, so if this is all happening, what do we do about it? It all depends what kind of a trader you are, what your risk levels are, and how active you are in the space. Like I said, the generalist money will keep rotating in, and it will go to the majors because that's what generalist dollars do. They need stocks with big liquidity, big market caps, and defined metrics. There's not that many options in the gold space there. There's big royalty players and there's big miners. The big dollars will keep flowing to them, so those charts will continue to perform. The classic pattern in a gold bull market is certainly that early investors in the space take gains from those spots. For instance, if you invested in Barrick 6 weeks ago, you're up 50% now. And if you, like me, are a more dynamic gold investor, you are probably considering selling locking in that 50% gain on Barrick in 6 weeks and rotating it down into developers with advanced assets or optionality plays because they come next. When you're looking for that, developers and advanced assets get that next level of attention because they offer clearly defined value growth. So, the asset is going from this stage to this stage to this stage. Perhaps it's going into production. The value growth is tangible, it's measurable, and that is something that gives a generalist comfort when they're investing in the gold space. But they also offer optionality, which is just that a rising gold price makes a defined deposit worth more because the value granted per ounce in the ground increases. And on top of that, they offer the potential of a deal coming in. Like I say, that momentum builds as the market goes forward. And so that's why they get the next round of attention. Also important to consider are straight optionality plays. Like I said, the value that the market gives a gold stock per ounce in the ground really rises during a bull market. And the takeaway from that for those who are interested in leverage plus is that big ounce counts really work. Right now, the way to approach that is to potentially look at big ounce counts that aren't of interest yet, because perhaps the grade is too low, the location's not perfect, there's something about it that is giving investors some pause. As the market develops, that pause will lessen. And so the increase in value per ounce that you get on those big deposits can really matter. I mean, the share price chart that I give here is for Northern Dynasty from 2003 until 2012, when it went from, 50 cents to $18. They were growing the deposit, but more important, I would say, is the fact that they were getting a higher and higher multiple on their ounces in the ground. Okay, if you're an exploration-oriented investor, as I certainly am, one thing that I want to comment on, I think I'm getting a little bit less worried about this as the days go on. I keep talking to companies operating in different jurisdictions, and it does seem like a lot of jurisdictions will be at least functional in the COVID world. Nonetheless, COVID is making exploration more expensive, less efficient, and in some places it will not be possible. So just make sure that the investment or the exploration companies that you are investing in right now will be able to work and have, strong targets that they're going to tap into, they're going to drill and explore in the next little while, and that they're going to be able to do that because as gold interest builds, the market is hungry for results. And the COVID pause in drilling and pause in activity that we're experiencing is ironically creating a little bit of a shortage of news just when the market has decided that it's really hungry for exploration news. So I would just say one comment, one thing to consider is just make sure the companies that you're focusing on have the ability to feed that appetite for news in the near term. Big picture wise, I think we're still early in this market, and investors early in a market gravitate first to, lower risk jurisdictions, new and exciting discoveries, and simple deposits. Later, they will also go to higher risk jurisdictions, older deposits that are getting a revamp, more complex deposits. But for now, simple certainly works best. I would steer clear of management that can't raise money right now. It is available. Obviously, there's always a balance in terms of protecting your share structure and all of that. So I'm not saying that everybody should just be raising willy-nilly. That's definitely not true. But if a company can't raise money now, that would be a red flag that I would want to investigate. Speaking of raising money, there's a lot of financings happening right now. Good explorers that need money so that they don't miss this exploration season, so that they can feed news into that news-hungry market, are raising money right now. So if you participate in private placements, certainly be paying attention. And the fact that it's a rising market as a whole, I have had to convince myself to broaden my list a little bit. I used to, for many years, as this market has slowly gained a little bit of momentum since 2016. I only consider the very best of the best. And now there is reason to believe that this rising tide is going to lift more ships. And so there is a little bit more opportunity to invest broadly if that's an approach that you like. Okay, that's what I have to say. These are my publications. I write a weekly newsletter that covers the majority of my portfolio, what I'm buying, selling, and thinking, and certainly starts with high-risk pre-discovery explorers and goes through to folks building mines. I also have a monthly newsletter that's written for the generalist investor who has less knowledge of the metals and mining space and is more interested in introductory information and lower risk investment ideas. And if you are interested in financings, I do offer a premium service where I work to secure allocations in good financings and make them available to you.